Okay, so basically chapter 19, we have two parts, right? So one is the share-based compensation. One is the earnings per shares. Okay, so those two parts. We spent quite a while, right, on those one. Yeah, okay, so that's all for that. Okay, so but if you have any questions, make sure you come to join my office hours. Okay, Monday, Wednesdays from 9 to 10 o'clock. Okay, so we're gonna start new chapter. Okay, chapter 21. This is our last chapter. Okay, cash flow statements. Cash flow. Any questions so far? Okay, so if not, let's start this chapter 21. Okay, so this is our last chapter. Okay, so this is about cash flow statements. Okay, so we've been working on cash flow statement for several times, right? So in your intro financial accounting in 121A. Okay, so now this is the time we're gonna finalize. Okay, so you're gonna see like the real cash flow statement. Okay, so we're gonna consider those complicated issues. Okay, so so today actually everything we cover today is like a review. Okay, so we just review what we learned so far, and then starting next week we're gonna work on a new method. Okay, so we're gonna consider some like complicated issues. Okay, next week, but not today. Okay, so we just review. So let's review. So cash flow statement. So we have a in cash flow statement we have three activities, right? So we have operating activities, investing activities, and financing activities, right? So we're going to talk about the cash flow, right? So cash flow means what? Cash inflow. Who said inflow or outflow? Inflow means we receive cash, right? So we receive cash flow in, right? So we have cash inflow. And cash outflow is what? Inflow, receive cash outflow means what? We're making cash payments, right? Cash flow out, right? So outflow. Okay, so we're going to consider those three activities, and each activity we're going to count those cash receipts and cash payments. Okay, and then we're going to count what is net changes in our cash. Okay, so that's the cash flow statements. So this is the example. You can see this is the example. We have three activities, right? Operating, investing, financing. Okay, and each activities we have cash inflow, out and our cash outflow. Okay, cash inflow means what? We receiving cash. Our cash gonna increase. Okay, outflow means we making cash payments, right? So cash gonna decrease, right? So then that's why we put here, see the positive here, inflow is positive, right? Outflow is negative. Okay, so then by the end of operating activities we calculate the total. Okay, so those total inflow minus total outflow. In this case we got 22. Okay, for this company. So then similarly for the investing activities. Okay, so if we have inflow will be positive, right? You can see here we have two inflows here, then we have two outflows. Okay, outflow means we have negative, cash decreasing. So then this is a total, right? Total for the investing activity, cash decreased by 19. Okay, and then financing similarly, right? We have inflow, we have two outflow, so net change is increase. Okay, so now we add those three numbers, right? Those are net changes. Okay, so we got 9. Okay, 9 is net positive, right? It's net increase in cash during this year. Okay, so cash from beginning of the year to the end of the year, the net increase is 9 in this $9 million, right? So then we look at the beginning year, the cash balance. If we have $20 million at the beginning of the year, we have $20 million cash. So by the end of the year, it should be $29 million. Okay, so this is the cash flow statement. Okay, this is the example. So why we need a cash flow statement? Remember, remember our accounting. We have two systems, right? We have the accrual-based accounting. We have a cash-based accounting. And accounting, this is GAAP, right? GAAP requires to follow the accrual-based accounting. Okay, accrual-based accounting. So in the accrual-based accounting, when you have revenue, you don't have to wait until you receive cash payments, right? You receive cash. Okay, so you don't have to wait until you receive the cash. You need to recognize revenues. Okay, similarly for the expense. So for the accrual-based accounting, the net income doesn't, when you have net income, doesn't mean your cash gonna increase. Okay, okay. So the but the but the but the business world, okay, the business world, cash information is very important. Okay, so we want to know what is information about the cash. That's why we need a cash flow statement. Okay, so you can imagine even sometimes company even have a huge amount of net income, net profit, in the income statement, but their cash, they might, they might see that their cash decreases. Okay, significant amounts. Okay, but we need the information about the cash because without the cash, we cannot run business. Okay, so that's why we want to know the information about the cash. We want to know the cash inflow, the cash outflow. Okay, so here we start. Cash is king, right? In the business world, cash is king. Okay, we want to know information about cash. Without cash, we cannot run business. Okay, so that's why we want to know the information. Okay, so that's why we need this cash flow statements. Okay, cash flow statements. So for the cash flow statement, when we say cash flow statement, actually we say this is cash and the cash equivalent flow statement. Okay, so when we say cash flow, actually it cash here it include the cash and the cash equivalent. Okay, in accounting, if you think about you imagine the balance sheets, right? So balance sheet, the first item in the balance sheet, it should be cash and cash equivalent. Okay, is that right? Balance sheet, starting with the assets. Okay, the first item in the asset is the cash and the cash equivalent. So you don't separate cash and cash equivalent in accounting. Okay, so you remember what is cash equivalent, right? Those are the very, very short-term investment. Usually the maturity date should be less than 3 months. Okay, anytime we need a cash, we can sell it to get the cash back. Okay, that's why we call it, these are just like a cash, right? So we call it cash equivalent. Okay, so in accounting, we combine, okay, when we do the reporting, we combine cash and cash equivalent together. Okay, so that's why when we talk about the cash flow statement, actually this is the cash and the cash equivalent flow statement. Okay, so you include both. Okay, so here those are the primary elements of the cash flow statement. Okay, so we know we'll talk about we have operating activities, right? Very important element. Then we have investing activities, right? So those the cash inflow, cash outflow for the investing, cash inflow, cash outflow for the financing activities. Okay, and this part here we call the reconciliation. Reconciliation, based on those three activities, you calculate net changes, right? Net increase or net decrease, and then you compare with the balance sheets. The balance sheet, the first item, right? Cash and cash equivalent. So you compare the beginning balance and ending balance, end of year balance. Okay. So then the total changes should be reconciled, right, with the beginning balance and ending balance. Okay. Or else, if not the same numbers, the differences between the beginning and the ending, if not the same items, same numbers from this cash flow statements, then something wrong, right? So we call that, reconciliation. Okay, we're gonna double check basically. Okay, when we prepare a cash flow statement. Okay, so the last element here we call non-cash activities. Okay, non-cash activities are those activities without cash impact. Okay, so we're gonna talk about that later. Okay, let me just give you an example. For example, we purchased equipment, but we didn't make cash payments. Instead, we signed a note, right, to promise to pay them in 5 years, for example, like this, right? So the journal gonna be a debit equipment, credit, notes payable, right? So you don't see cash. Okay, there's no impact on cash. That's called non-cash activities. Non-cash activities not in, we don't see the non-cash activity in the statement cash flow, but those one, if these are very, very significant numbers, you will write a note, okay, to the cash flow statement, okay, to explain these non-cash activities. So those are the primary elements, okay, of cash flow statements. Okay, and let's work on those one by one, right? So we talk about the operating, right? Operating, investing, financing. What are those operating activities? Operating activities are those anything related, okay? So we call it related to the elements of net income. Those are the revenue or expenses related activities, okay? Revenue or expenses related activities. Okay. How about the investing? Investing, we have two kinds of investing. Okay. One, you can call it investment. We purchase another company's bond or stock, right? So we're making investment. And so another investing, I can call that internal investing. So we invest in ourselves. For example, we purchase a new equipment, we build a new factory, right? Those are the internal investing. Any cash flow activity related to our internal investing or external investing will be reported in this section. Okay, financing activities. Those, we have two kinds of financing. One is called the debt financing, one's equity financing. Okay, debt financing is when we borrow money, right, to get financing. Equity financing, we issue stock, right? We issue common stock, okay, or preferred stock, we have to get financing. Okay, so those, any cash flow related to those debt financing or equity financing will be reported in this section, financing activities. Okay, so those are three activities. Okay. Let's talk about those activities in details. Okay, let's talk about those activities in details, starting with the operating activities. Okay, operating activities. So we have these just keep in mind the operating activity. Think about what is the operating activity? Are those cash inflow or cash outflow related to our net income items, okay, which is revenue or expenses, right? So any revenue related cash flow activities or expenses related cash flow activity will be classified in this categories. Okay, cash flow from operating activities. Okay, those are revenue expense related activities. So if you look at this, so this one just give you the example of the income statement, right? You can see this income statement, and this part here is the cash flow from operating activity, which tries to compare, right, to show you the relationship. Okay, so if you look at the income statement, this starting with revenues. So here we have two revenues, right? Sales revenue, investment revenues. Okay, and then related to sales revenue. Okay, so you sold your merchandise, then we will receive cash from our customers later on, right? So see these are related. So this cash received from customers is related to our sales revenues. Okay, and similarly for the investment revenue, right? So investment revenue, so we making investment, right? So then we receive, for example, dividends. Okay, we receive dividends. We call it dividends revenue. Okay, those cash receipts, right, for the dividends, so will be related to the dividends revenues. Okay, they're related. They may not be the exactly same, right? But they're related because there's a receivable in between those. Okay, but some revenues has no cash flow. Okay, for example, the gains. Okay, the gains. For example, uh, you sold your buildings. Okay, you sold your building then for more than the book value. So then you recognize the gain, right? Gain is one of the revenues, but we don't have cash inflow related to the gain. Okay, so that's why you know there's no cash flow related to the gain. Okay, so that you don't have it also. Okay, and similarly for the expenses. So the expenses here kind of is related. For example, cost of goods sold, right? Okay, so you have a cash um, outflow, which is called the cash paid to suppliers. Okay, you need to purchase your inventory, right? Then you're gonna sell it, right? So you recognize those cost of goods sold. So the cash paid to suppliers will be related to the cost of goods sold. Okay, they may not be exactly the same, but they're related. Okay, remember, but between those, you have accounts payable, and you also have those inventories, right? Between those, and like a salary expenses, right? You make a payment to the employees, so cash payment to the employee is related to salary expenses. Again, these are not exactly the same, very likely, right? So because you have a salary payable in between. Okay, and etc. You have those kind of related, right? So those related, and then we do for the expense, we do have some non cash related, okay, expense. For example, depreciation expenses. Okay, so remember depreciation expense is just a cost allocation, right? By the end of the year, you recognize you debit depreciation expense, you credit accumulated depreciation. So we don't pay with cash, right? We don't use cash to pay for the depreciation. Okay, that's why it's no cash flow regarding these non-cash expenses. So this is just give you briefly example, right? To see, those are the cash flow from operating activity are those either revenue related activities or expenses related cash flow activities. Okay, so like this, right? So those cash inflow relate to our revenues, right? Those are revenues, okay? Inflow from customers relate to our sales revenues, right? Inflow from the interest or dividends relate to our investment revenues. So those are revenue related. Outflow are those expenses related activities, cash flow activities. Okay, so inflow gonna plus, right? Gonna increase your cash, right? Outflow gonna decrease your cash. So then you calculate the net changes, right? In the cash. Okay, net increase or net decrease. Okay, that's the cash flow from operating activities. So this is the operating activity, and then to report, okay, the cash flow from operating activity, you have two methods. If you remember that, right? So you have direct method, you have indirect method. Okay, direct method, indirect method. Let me. I think I need to. Let me write it down here. Okay, so let's see the cash flow, cash inflow. Okay, from operating activities are related to the revenues, right? Related to revenues, and the cash outflow from operating activities, okay, are related to those expenses. Okay, so net cash flow, okay, so this one minus inflow minus outflow gonna be net cash flow, right? From operating activity. Let's just talk about operating, okay? So this difference between them, we got the net cash flow from operating. Okay, so that's why we talk about the direct method. Okay, direct method, you're gonna list, the cash outflow from operating, all of the cash inflow from operating, all of the cash outflow from operating, then you calculate net cash flow from operating. Okay, so direct method, this is called the direct method. Okay, so you go this way. Okay, to calculate, you want to calculate this number, this one, right? Net cash flow. Okay, so from this way, you calculate, this is called the direct method. So what is indirect method? Indirect method, the difference between the cash inflow, cash outflow, you got net cash flow from operating. How about difference between revenue and expenses? That will be net income, right? Since those are related, so this net cash flow from operating activity are also related to net income, right? They're related, okay? So then you want to figure out what is net cash flow from operating. So you actually can starting with this net income plus minus some adjustment. Then you can calculate this net cash flow from operating. Okay, so that's called the indirect method. You figure out this net cash flow from operating, indirectly. Okay, so direct method, indirect method. Okay, so this is an example of direct method. You can see we have a cash inflow, right? So with this cash inflow from customers, cash inflow from investing revenues, okay? Then we have cash outflow to pay to suppliers, right? To pay to the employee, pay for the interest, for the insurance, income taxes, right? So then the total here is the net cash flow from operating activity. This is direct method because we list those cash inflow, cash outflow directly, then to calculate what is net cash flow. Okay, so plus minus, right? The net cash flow is 22. How about the indirect method? Indirect method, we start with this net income, right? Net income. And then we're going to think about those adjustments. Okay, so we have a bunch of adjustment. Okay, so by the end, these are the adjustment, right? So then after these adjustment, the net cash flow from operating activity should be 22. Okay, so again, that's what we talk about this, right? Like this. Okay, so this is the direct method. This is the indirect method. Okay, so those are two methods. We're going to work on those two methods more detail next week. Okay, so now let's talk about this, the cash flow from investing activities. Okay, investing activities. From investing activity and financing activity, we always use the direct method. Okay, there's no indirect method. So you just list those cash inflow and cash outflow. Okay, and then calculate the total. Okay, so investing activities. Again, we talk about investing. We have two kinds of investing, right? We have internal investing. We have external investing. Okay, so external investing, we talk about those investment, right? We purchase another company stock, or we invest in another company bonds, right? So those are called, the external investing. And internal is what we invest in ourselves. Okay, so we purchase a new factory. Okay, we purchase a new equipment, right? We purchase a patent. Okay, even those intangible assets, right? So those are internal investing. Okay, so any cash inflow, cash outflow related to those, so will be classified, in these categories. Okay, so those are the example. For example, purchase long-term assets, right? So let's say we purchase a building. Okay, purchase the equipment, right? So we spend the cash. Okay, we have capital outflow. Yeah, good question. Yeah, go ahead.
What is non-trade receivables?
Non-trade. Oh, this one. Okay, so you're okay with those one, right? So non-trade receivable is what? Is the for example, we have actual cash, okay, and then someone want to borrow money from us, okay, so we lend money to this to another company. So remember, this is not a bank, okay? This is just regular company, but we just have a lot of cash, right? So then someone want to borrow money from us. They said that's fine, right? We can earn a little bit interest, right? So then when they borrow money from us, guess what? We give them cash, right? What we receive? We receive those notes receivables, right? So we should debit notes receivable, credit the cash, right? So that's why we have cash outflow, okay? But in the meantime, we have notes receivables. So that notes receivable is called non-trade receivables.
Got
okay?
it.
So for that one, you have cash outflow, right? You spend the cash, you give cash outside, okay? So then similarly, when you collect, okay, so later on, they're gonna make payments, right? They're gonna pay us back. So then we receive cash back, okay? So we lend money to why we call that investment, okay? Investing. It is investment, right? Because we want to make money, we want to earn a little interest. Is that right? That's also investment, okay? Yeah, external investment. So so we have external and internal, okay? We have cash outflow or cash inflow. It makes sense, everyone, about investing. So again, for investing financing, this is just a direct method, right? So there's no indirect method, okay? So you just list those item by item, okay? And then calculate the net changes. Let's work on this. Yeah, you need to know which one is the which one if this is investing or not, okay? So then you're gonna calculate the net changes.